Welcome to the Financial Freedom Secrets Show. This is your host, Jackson Millan, the Wealth Mentor, helping business owners create financial freedom faster by mastering the language of money. Want to see how well you're tracking towards financial freedom? Complete our 40-point financial performance scorecard at wealthhealthcheck.com.au. That's wealthhealthcheck.com.au. The average score for most business owners is 18 out of 40. So complete the scorecard now and see how well you're tracking towards financial freedom. G'day guys, this is Jackson Millan, the Wealth Mentor, and we are here for another episode of the Financial Freedom Secrets Show, where we're going to be continuing our series of playbooks, where we're going through the Wealth Mastery Machine signature solution, how we've helped our clients build over $3 billion in combined wealth. This is a specialist series for seven-figure plus business owners to actually show them exactly how we achieve outcomes for our private clients. I'm going to give you all of the tools, I'm going to give you all of the frameworks, and essentially it's just going to be up to you to take action to ensure that you start implementing these strategies. But at the very least, you're going to be adding new tools to your kit bag so you can have confidence and clarity around how you work towards accelerating your path to financial freedom. Now, we've been covering off a podcast series for the last 4 or so weeks. We've been going through each pillar of the signature solution. I'm going to give you a bit of a crash course. Now, if you want to get access to the current playbook, where we're going to be talking about the Debt Destroyer system. Essentially, how do we alleviate and remove and destroy our bad debts? How do we use good debts to allow us to accelerate our wealth creation? And ultimately, how do we use that way to accelerate our path to financial freedom? This is going to be a really powerful guide, but I'm excited for you to implement this along with all of our other playbooks. So make sure that you go to wealthhealthcheck.com.au and complete our financial performance scorecard. After you complete the scorecard, you'll get a customized report showing you exactly how you're tracking across your wealth strategy, across your tax strategy, and across your profit strategy. And as a result, you'll get access to all of the other playbooks, along with our best calculators, tools, and also all of my best-selling books. There's a ton of value to be had, so make sure that you go and complete the scorecard so you can extract the most out of this podcast. So let me share my screen and give you a little bit of a rundown. So what we're going to be covering is this Debt Destroyer Playbook, and this is a comprehensive guide for seven-figure business owners who find themselves in this kind of wealthy person's debt paradox. The thing that most people don't understand about wealthy individuals is that they don't avoid debt, they master it. Like the average person sees debt as a burden to eliminate. The wealthy see debt as a tool to multiply their wealth. The difference is not just philosophical, it's mathematical. And this forms a very important part of our overall signature system called the Wealth Mastery Machine, where we help our clients create financial freedom and we help them overcome the biggest things that get in the way. Not having a plan, not having the cash, and not having the consistency to get there. Now, we spent a period of time going through the define piece, going through the money mindset, going through the real roadmap, going through the simple strategy. And in our last podcast episode, we went through the sustained surplus piece and how do we maximize our cash flow to allow us to create more wealth. Today, we're talking about the destroy debt. And in our next episode, we're going to be going through the automate investments. Now, the reason why this playbook exists is because you build a seven-figure business, you understand leverage in a business context. But most successful business owners make critical errors when applying leverage to their personal wealth building. So one, they carry the wrong types of debt. They carry high interest consumer debt instead of investment debt. Two, they underutilize their borrowing capacity. As a general rule, the banks will lend 5 to 6 times income, but most don't maximize this. Three, they pay off good debt too aggressively and they miss opportunities to recycle their debt into wealth building assets. Four, they structure their entities inefficiently. They limit their borrowing capacity through poor entity design. So we've designed this playbook to systematically address these issues using the proven systems and strategies that we've used with thousands of business owners to accelerate their wealth building. So let's get stuck in. Let's talk about the fundamentals of debt. So there is a science of debt classification. So first and foremost, we need to understand the difference between good debt and bad debt. So a fundamental principle of wealth building through debt is understanding the difference between debt that builds wealth and debt that destroys it. This isn't about just interest rates, it's about a complete financial ecosystem that debt creates. So bad debt characteristics. There's no tax deductibility, so you end up paying interest in after-tax dollars. It's usually linked to depreciating or consumption assets, so the underlying asset loses value or provides no investment return. There's a high opportunity cost. The interest repayments could be deployed more efficiently elsewhere. And cash flow negative. This creates an ongoing expense without offsetting income. So some examples of this are credit cards, so 19% interest, no tax benefit, consumption purchases. Personal loans, 8 to 15% interest, no tax deduction, often for consumption. Car loans, unless it's 100% for business use, it's a depreciating asset and there's limiting tax benefits. And the other one that most people overlook is their home. Although your home appreciates, because it is not an investment asset, does not produce income, you need to pay off that debt in after-tax dollars. So let's talk about good debts. Good debt characteristics is there's tax-deductible interest, so it effectively reduces your cost of borrowing by your marginal tax rate. Appreciating or income-producing assets. The underlying assets grow in value or generate income. There's leverage amplification. Allows you to control more assets than your available cash. And cash flow positive or neutral. The investment returns offset the actual borrowing costs. So some examples are investment property loans. Tax deductible, it's an appreciating asset, we're producing rental income. Business loans for income producing assets, so we use it for a business acquisition. This is something that I've done a lot of. Tax deductible, and it fuels the business growth. Margin loans for dividend paying shares, right? Tax deductible, potential capital growth and income. So let's go through some mathematical realities here. We've got two scenarios with $100,000. We have 100 grand and we pay off a home loan that we're paying 6.5% interest. The annual saving is $6,500 in interest. The tax position, no change because the home loan interest is not tax deductible. The net benefit is $6,500 annually. Now, assuming we set this up correctly, scenario B is that we keep the home loan, we invest $100,000 in dividend shares returning 9%. The annual return is $9,000. The annual home loan interest cost is $6,500. The investment loan interest tax deductible is $7,200. The tax benefit on the investment loan interest at a 47% tax rate is $3,384. So the net benefit is $9,000 minus the $6,500 plus the $3,384. So the net benefit is $5,884 annually, plus the potential capital growth on the investment. So this is why wealthy individuals carry substantial good debt, even when they could pay it off. So let's talk about the debt efficiency matrix. Not all debts are created equal. So we need to understand cash flow versus interest rate optimization. So a lot of traditional advice focuses on paying off the highest interest rate debt first. While mathematically this makes sense for minimizing total interest, this ignores cash flow optimization and it also ignores the mindset factors. So we need to understand that for business owners, we want maximum flexibility. And we're not all created equal. We have different mindsets. So we need to understand debt efficiency ratios. So a debt efficiency ratio reveals how much of your monthly cash flow each debt consumes relative to the balance owed. So the formula is minimum monthly repayment divided by the total balance multiplied by 100. So why does this matter? Lower ratios preserve more cash flow. Cash flow flexibility enables opportunity capture. And business owners need liquidity for unexpected opportunities and challenges. So let's go through a couple of scenarios here. Credit card, balance is $20,000, minimum repayment is $400, the efficiency ratio is 2%. So the annual cash flow impact is $4,800. The car loan, 40 grand, 650 minimum repayment, the efficiency ratio is 1.625. So the annual cash flow impact is $7,800. An investment loan, 200,000, minimum repayment is $1,100. The efficiency ratio is 0.55%. So the annual cash flow impact is $13,200. So the insight is the investment loan, despite having the largest balance, has the lowest cash flow impact relative to its size. This is the efficient debt. So what we do is we do a traffic light system. So if the percentage is under 1%, we call this a highly efficient debt. This is the green zone. The yellow zone is 1 to 2%. This is moderately efficient. We address after the red zone. And then the red zone is over 2%. This means that it's inefficient and we attack these first. The strategic application is for bad debts. We attack the highest efficiency ratio first, so that has the worst cash flow drains. For good debts, we preserve the lowest efficiency ratios, best for cash flow optimization. So let's talk about the debt destruction strategy. So there are three proven repayment methods that we use, depending on a particular client. So we've got to understand that this is about psychology versus mathematics versus cash flow. Research shows that successful debt elimination requires matching strategy to personality and circumstances. The three primary methods each optimize for different factors. So, one, the debt avalanche. This is the mathematical optimization. So, we pay minimum amounts on all debts. We direct all extra repayments to the highest interest rate debt first. So, the educational principle is that pure mathematical optimization minimizes the total interest paid over the life of the debts. So, for example, if we've got a credit card at 19.9%, a personal loan at 12%, a car loan at 8.5%, we have extra capacity of $2,000 a month. We focus on the credit card first. Once that's paid, we pay off the personal loan. And then after that's paid, we pay off the car loan. The benefit is that over the time, we save $28,000 over the payoff period, and it will take us 31 months to extinguish all of the debts. So this is best for high disciplined individuals, those that are motivated by optimal financial outcomes, and of course, people with stable cash flow who can maintain that long-term focus. The potential drawback is that there are potentially slower psychological wins that can reduce motivation for some people. So let's look at method 2, which is the debt snowball. This is the psychological optimization. So how it works is we pay the minimum amount on all debts, and we direct all extra repayments to the smallest balance first, irrespective of the interest rate. So the educational principle is that it leverages behavioral psychology. It creates quick wins to create momentum and sustained motivation. Like studies show that behavioral economists show that people who achieve early wins are 40% more likely to complete their debt elimination programs. So using the same example, we'd go credit card, 15 grand, personal loan, 25 grand, car loan, 35 grand. For some people, it may result in the same order. This really depends on the sizes of your debts and the interest rates of those debts. So first debt eliminated, 7 months, quick psychological win, momentum effect, $400 a month freed to attack the next debt. And the total time, it's actually often similar, but this depends on the balances and the interest rates. So this is best for people who need motivation through visible progress, for those who potentially failed in past attempts at debt elimination, and for individuals with variable income who benefit from eliminating those payment obligations quickly. Now, method 3 is a little bit more complicated. We call it the debt traffic light, and this is about cash flow optimization. So how it works is we pay minimum amounts on all debts. We attack the highest efficiency ratios first, so the worst cash flow drains, and this is based on that previous example. So the principle here is that we're optimizing monthly cash flow, providing maximum financial flexibility the soonest. So this cash flow flexibility enables business opportunity capture and provides a buffer for that volatility. So for example, we've got similarly credit card 2.67% efficiency, personal loan 2.32%, car loan 1.86%. We pay off the credit card, personal loan, car loan. It actually happens to match the other scenarios. So once again, it depends on what the minimum repayments are and your various loans. So the benefit here being is that if we consider the scenario, we've got a small personal loan at 10 grand at 15%, payment is $500, efficiency is 5%. A large mortgage, 400,000 at 6.5%, payment is 2,400. The efficiency is 0.6. The traffic light attacks the personal loan first, despite the mortgage having the higher total interest cost, because eliminating that $500 payment provides immediate cash flow relief. So there's a scenario here for you to go through doing these calculations yourself. All right, so let's talk about borrowing capacity. This is really important. So chapter 4, understanding bank lending criteria. We need to understand how banks really see and assess lending capacity. Like banks use complex algorithms to determine how much they'll lend, but the fundamental principles are pretty straightforward. Understanding these principles allows you to engineer your financial position for maximum borrowing capacity. So, the core lending formula is that banks will typically lend between 5 to 6 times your annual income. And this is obviously subject to debt servicing ratio constraints, living expense assessments, asset security requirements, and your credit history. But income matters more than your wealth because banks lend based on your ability to service the debt rather than your ability to repay the debt based on your wealth, okay? So a business owner with a $5 million net wealth but $200,000 in income gets less lending capacity than someone with $1 million in net wealth and $500,000 in income. So unlike employees, business owners can influence their assessed income through their salary and dividend optimization, through their entity structure design, through their income timing and smoothing, and through their expense categorization. So let's talk about the income engineering strategies. We need to optimize our income for maximum borrowing power. So strategy one is salary versus dividend optimization. The problem is that many business owners minimize their salary to reduce payroll tax, their superannuation costs, and in many cases they destroy their borrowing capacity. So we want to consider that each bank has a different lending criteria. So we want to optimize our salary at the point where borrowing capacity benefits outweigh the tax costs. Because as a general rule of thumb, if you pay a little bit of extra personal income tax and as a result you're able to go and buy another investment property, in many cases the growth in the first 1 or 2 years of owning that investment property will significantly outweigh the extra cost on the tax. Okay. The educational principle is that banks are conservative and they usually will prefer salary income over dividend income because salary is more predictable. Dividend can be varied and eliminated by business decisions. And salary income is accessed at the full value. In some cases, banks will discount dividends depending on their policies. So let me give you an example. Current structure, business owner on 180,000, dividend 200,000, total 380,000. If we look at 380,000 times by 6, the debt capacity is 2.28 million. In this particular scenario, the owner increased salary to 300,000 and reduced the dividend to 80,000. It's the same income. But the reality is that if we look at the bank assessment, closer to 350,000 times by 6, we've got a $2.1 million capacity. But what we realize is that in this particular scenario, some banks will actually discount the dividend by 20 to 30%. So what the structure it typically is at 180,000 at 100%, the dividend at 70%, which actually means that this potential business owner might only be able to borrow 1.92 million. So that's a pretty significant reduction as a result of not structuring the income the right way. So if we have a lender that does take 100% of salary and discounts dividends, we can increase our borrowing capacity by $216,000. Okay, so something to keep in mind. So the important part about this particular exercise is that you need to work with a strategic mortgage broker who's going to help you understand the best way to structure your income in order to maximize your borrowing capacity to facilitate your growth plan. So there's some activities here for you to work through to do those numbers and to have conversations with your strategic mortgage broker. If that's something you need help with, feel free to reach out. Now, strategy two is income stream diversification. So multiple income streams provide both increased total income and risk diversification for the banks. So if we've got multiple income sources that are consistent, it can put us in good stead. So what can we do? Primary business income, salary, it's reliable, and obviously this forms the foundation. Investment income, rental properties, dividends that you've got, interest that you've got. Usually banks assess these at 75 to 80% of actual income. Secondary business income, consulting income, board positions, licensing, and then obviously passive income streams. So it's about understanding what are your current income streams, what's the stability, chat to your broker about the bank assessment rate so then we can work out your total assessable income in the eyes of the bank. And then what we can work out is what can we do to improve those streams of income over the next 12 months, okay? The key part here is that when you work with a good strategic broker, they're going to give you one of three outcomes. One, you have an equity consideration, so you need to have a certain amount of equity available in order to facilitate your strategy. Two, you need a certain amount of income in order to facilitate that strategy, and you either have those right now or you don't. Or three, we can set a target of either equity or salary or income, and we can work towards that over the financial year, knowing that if we could achieve that, then we're able to advance the strategy. Let's talk about chapter 6, which is the expense engineering for maximum capacity. So how do banks assess living expenses? There are really two assessment methods for living expenses. There's declared expenses, what you tell them that you spend, and then there's benchmark or what's called HEM. There's industry standards based on your income and family situation. And then, of course, there's the bank statement analysis, which is becoming more common. The banks are using AI in order to analyze these things. So it's really important that we work out how do we structure our expenses. Now, unlike employees, business owners can legitimately move many expenses through their business, reducing personal expense assessments. And this is for legitimate things. So you need to consult your accountant and your mortgage broker to ensure that you're doing this the right way, like vehicle costs, mobile phone and internet, home office expenses, professional development and training, business meals and entertainment, professional subscriptions and memberships. The idea here is that we can look at opportunities to optimize these expenses and reduce those spendings, which in turn can increase our borrowing capacity. So the key part here is have a chat with your broker, itemize all of your expenses, and then look through what are the things that you could potentially move to the business legitimately that would allow you to optimize that borrowing capacity. So there's some good opportunities here for you to work through. Next is the entity structure engineering. So we need to use structures because they affect our lending. Now, obviously, the lending criteria for each bank is shifting and changing all of the time. This particular strategy has gathered a lot of steam in recent times, and banks are already coming out and closing some of these loopholes. But as a general rule, different lenders treat different business entity structures differently. And understanding these variations allow you to engineer your structure to maximize borrowing capacity. So, for example, the big four banks typically aggregate all related entity debts. They've got a conservative approach to cross guarantees. They prefer simple, transparent structures, and they've got a strong preference towards those personal guarantees. Depending on the regional banks, and this changes all of the time, they have different policies around whether they look into debts that exist in an entity or if the debt is being serviced. In some cases, they ignore it. There's lots of different things. And of course, there's non-bank lenders who typically have different considerations once again. So the important part here is about working with a strategic mortgage broker who understands these policies and knows which lender that we need to work with in order to maximize that borrowing capacity. So it's like, okay, well, if we have a strategy one, we've got the clean entity approach. Sometimes we establish a new entity with no existing debt or guarantees for fresh borrowing capacity. Great, fantastic. Sometimes we want to utilize a structure in order to isolate debt to allow us to recycle that borrowing capacity. This is called a special purpose vehicle strategy. So once again, it's important that you're working with your advisors to then work out how do we review your current structure analysis, what is the capacity of each of those structures, and is it the benefit of adding any new structures which could help us unlock additional borrowing. All right, let's talk about our lender diversification matrix. So there's no point being loyal to any particular bank anymore because banks have strict policies and the tenure that you may have with the bank doesn't really count for much anymore. So don't be afraid to go and look at other banks. Like for example, you might use the big banks for your personal residence and for your business. Then you're going to use some regional banks for your investment properties 1 and 2. Then you might have to go to a non-bank lender for your properties 3 and 4. And then you might have to go to a credit union for your equipment finance or your SMSF. Like this is about ensuring that we're using debt like a tool, like a hammer or a screwdriver, and we are essentially using it to facilitate the strategy. Okay, let's talk about the part 4, which is the investment property scaling system, okay? This is the mathematics of property investment scaling because we've got to realize that debt and property go hand in hand. The idea here is that we need to understand the income requirements for portfolio growth. Like most business owners underestimate the income requirements for building substantial investment property portfolios. If you understand the mathematics, then it allows you to systematically plan rather than hopeful purchasing, right? And this is where so many business owners get stuck. So the fundamental equation, required income is the target portfolio debt divided by 6 plus a safety margin. So let's say, for example, you want to build a $5 million investment portfolio. If we've got 5 properties at $1 million average value, usually it means we're going to need $4 million in debt, assuming that we're contributing a 20% deposit. So if we think about this, in order to borrow $4 million, we divide that by 6, we're going to need at least $667,000 in annual income. But this ignores obviously the rental income from the properties, the debt recycling opportunities, and of course the debt entity structure benefits that we might get. So for example, we've got property 1, $800,000 purchase price, loan required $640,000, annual rent $35,000. So if we look at $640,000 minus 26 rent at 75%, our net borrowing impact is $614,000. Property 2, $900,000, we need $720,000, annual rent $40,000. 720 minus 30 is 690. Property 3, 1.1, 880 loan, 50K in annual rent, 880 minus 37 is 843K. Then we've got property 4, 1.2 million, 960, 55,000 annual rent, 960 minus 41,000 is 919K. And then property 5, $1 million, 800 grand loan, 45k, 800 minus 34 is 766. So if we think about this, the net borrowing requirement is 3.83 million. So if we think about this, 3.83 divided by 6 is 638,000. So it's more achievable, right? The rental income reduces the effective borrowing requirement by about $170,000. So the key here is we need to understand what income we've got to earn. It's still a pretty considerable amount of income. And if you're not increasing your income, then you're going to be eroding your borrowing capacity over time. This is where a lot of people get stuck. So let's talk about the property acquisition strategy. So we want to be systematic here as opposed to opportunistic. Most investors buy properties opportunistically when they find a good deal or they feel ready. Wealthy investors buy systematically according to predetermined criteria and timelines. So, the predetermined criteria eliminate emotional decision making. The timeline discipline ensures consistent portfolio growth. Financial preparation maximizes negotiating power. Market timing flexibility allows you to capitalize on market cycles. So, strategy 1 is the cascading deposit system. Use equity from existing properties to fund deposits for subsequent purchases, which accelerates growth. So property 1 is always the hardest one to get into. You've got to save 20% cash. Property 1 appreciates, which creates equity. We use property 1 equity for a deposit for property 2. We refinance and we cash that out. Property 1 and 2 appreciate. Combined equity funds property deposit number 3, and we continue to cascade. The limiting factor here is usually borrowing capacity. So here's a mathematical example. Available cash for deposits, 200 grand. You can buy one property at $1 million. 5% growth after 12 months. The property's worth 1.05. We've created $50,000 of equity. We've got our total equity available, 250,000, assuming we continue to save. Property 2 at $1 million. We can use 200 grand of equity, 50k cash top up. Cool. After 24 months, 1.1 million. We've got an additional 50k in equity. Property 2's gone up by an extra 50k. We've got 100k plus any remaining cash that you've accumulated from your business profits and surplus. Then we use that to buy property 3. This just continues to accelerate the strategy. So there's an activity here for you to work through to do these calculations for yourself. Now, strategy number 2, geographic and asset class diversification. This is about concentration versus diversification risk. So many investors buy property in their local area because it's familiar. While local knowledge is valuable, that geographical concentration creates uncertainty, and not every market does the same thing at the same time. So this can, in many cases, stifle your growth and in turn your ability to compound your portfolio. So we want to ensure we've got economic cycle protection, like different areas peak and trough at different times. Regulatory risk mitigation. Local government policy changes can affect a specific area, like what we've seen in Melbourne in the last couple of years. Market access, ability to buy in highest growth or highest yield areas irrespective of the location. And then exit strategy flexibility, like multiple markets provides more sale opportunities as those cycles go through. So the key thing is your business income provides stability, allowing you to invest in high growth areas that might have more volatile rental markets, or we don't need to invest for cash flow because you've got cash flow elsewhere. So here's an activity for you to work through to get some clarity around your strategies. Now, part 5. This is really cool. Debt recycling. This is a great strategy that we use with many of our clients who are more sophisticated because this is a really great way for you to accelerate your wealth. So we're going to understand this is a wealth multiplication mechanism. Like, this is arguably one of the most powerful wealth building strategies available to property owners, but it's underutilized because people lack the understanding because it's a little bit complex. So here's the core concept. We need to systematically convert non-deductible debt, so your home loan on your principal place of residence, into tax-deductible debt, investment loans, while building an investment portfolio. Why does it work? There's 4 things. 1, tax efficiency. The investment loan interest is tax-deductible, effectively reducing your cost of borrowing. 2, compound growth. Money works in 2 places, paying down the home loan and growing investments at the same time. 3, accelerated wealth building. You're building investment wealth whilst paying off your home loan. And flexibility. It maintains liquidity through the investment portfolio while you're smashing that. So let's go through a traditional approach. If you primarily focus on paying your home loan off as quickly as possible, it might take you 15 or 20 years to be debt-free. Then once you've paid it off, you then start building wealth. The opportunity cost is the lost years of that time that your investments have not been compounding and growing. So debt recycling, we focus on the home loan we convert the home loan to investment debt to build the portfolio. Same period, but we're building wealth simultaneously. We immediate tax deductions on that investment debt, and it allows us to have a compounding benefit: investment growth plus tax savings plus a home loan reduction. So I've put together a case study scenario here for you with some assumptions. And what this effectively shows is the scenario whereby, if I just zoom in a little bit, got a husband and wife who's got a home that's worth 1.2. They've got 500 grand on their mortgage, paying 6%. They're currently earning household income net of 179,000, and that provides an annual surplus of 35 grand. We need surplus in order to facilitate this strategy. We've made some pretty conservative assumptions in terms of a 6.5% interest rate on the investment debt, the portfolio growth of 4%, dividends of 3.5%. And what this basically shows is, okay, the traditional strategy of paying off the mortgage takes about 10 years, and then from there investing in the portfolio, versus the debt recycling of where we're shifting bad debt into good debt. We're using those good debt to buy good investments. We're using that investment income in order to pay down the bad debt faster, and then we rinse and repeat the strategy. As we can see, the traditional strategy over a 20-year period of time, or I think 25-year period of time, gets their total net wealth accumulated over that period of time of 2.622 million. Whereas as a result of the debt recycling strategy, even after paying off the investment debt, we are able to build $3.544 million in investment assets. So we're talking nearly $1 million differential as a result of leveraging this strategy. So this requires some personal advice, but I've given you some frameworks to consider around whether you can be considering debt recycling as part of your strategy. So I've also included some insights around the mechanisms for setting up and recycling the strategy for you as well. All right, so the implementation framework. What we've got to understand is that this is about, firstly, understanding the systems for wealth building. Like, successful debt optimization and wealth building requires systematic implementation rather than ad hoc actions. This framework ensures that nothing falls through the cracks while you're maintaining focus. So, phase 1, foundations and analysis. Go through the assessment, do your debt audit, select your strategies. Go through your income and expense analysis. Go through your entity and capacity planning. Make sure you've got the right professional team. You need a good financial advisor who can help you with the debt recycling. Make sure you've got a good accountant that can help you with the entity and the income optimization. Make sure you've got a strategic mortgage broker who understands this strategic planning. And of course, any legal consultation to set up any entities. Work through the implementation preparation of the income engineering, the entity structure implementation, your lending planning, your strategy refinement, and the systems establishment. Then we can go through the debt destruction launch, investment implementation, monitoring systems, and then our first quarterly review. Our phase 2 is usually from months 4 to 12, is where we go through the acceleration and optimization. So how do we continue to maximize our borrowing capacity? This should be happening around each financial year, so we know what we're doing. Portfolio building. Once we've got the capacity, how do we continue to snowball and build that portfolio? And then the systems maturation, like what's working, what's not, how do we continue to optimize and grow, and then use that compounding to continue to accelerate the strategy. So then that leaves you with your personal implementation plan. Go through the guide, get really clear on the tactics and the strategies, work through your priorities, and get really clear on what you need to implement and execute in order to get the most out of this. Now, there is a really key consideration here around risk management and quality assurance. The idea here is we want to protect our wealth while we're building it. There are risks associated with debt, okay? Whether it be your existing debt or taking on new debt, even if it is good debt, okay? What we've got to be mindful of is that the banks are always going to come knocking for their interest rate. And with debt comes increased responsibility, which means we need to take an appropriate risk management. So we've got to consider our cash flow risk. What is the potential volatility that could impact our ability to service and maintain those debts? So think about what's your emergency funding? What's your insurance coverage? How do you diversify? How do you make sure that you're conservative with your serviceability and your loan to value ratios? Investment risk. How do we be conservative in terms of our investment strategy, ensuring that we're investing in the right things that are going to allow us to accelerate our wealth? Interest rate risk. Price in your ability to afford up to a 2% price increase on those debts. We've seen many people who thought at the very bottom of the interest rate cycle when rates were 3%, that they were going to stay there forever. And then when rates went up to 6%, in some cases 7% or more, that those people were absolutely crushed. So you've got to be very mindful that interest rates can shift and change, model the impact of a 2 or 3% price increase. And then go through your risk assessment and mitigation plan, okay? We pay a big price for certainty. it's important that we take extra risks, but we consider how we buffer against those risks so we don't do anything reckless. So then we've put together a quarterly review framework with some really powerful questions for you to review your progress evaluation, your strategy optimization, your risk assessment, and your planning moving forwards. So let's get into the final words. You build a 7-figure business. You now understand leverage, you understand systems, you understand strategic implementation. The difference between business owners who remain wealthy and those who become truly financially free isn't luck or timing. It's this systematic application of proven wealth building principles. Okay, the mathematics are clear. If we implement this strategy effectively, it could save you upwards of 50 grand annually. The income engineering could increase your borrowing capacity by upwards of $1 million. That's an extra property at least. Debt recycling could create an extra $500,000 or more in additional wealth over the next 10 years. And then structuring these entities the right way could provide ongoing tax benefits of over $20,000 a year, okay? Like, the strategies are proven. Thousands of business owners have used these exact methods to accelerate their wealth. So you've got a choice. You do nothing. You continue with your current approach and you accept average results. 2, you do it yourself. You implement these strategies without professional guidance and risk making costly mistakes. Or 3, you do it systematically. You follow this playbook, you get professional support, and you accelerate your wealth building the right way. Your 7-figure business provides you with income and it gives you advantages that above and beyond 95% of other investors. So the question isn't whether these strategies will work. The question is whether you'll implement them systematically and consistently. Your wealthy self is waiting. The playbook is complete and your implementation starts now. So I advocate that you go on to wealthhealthcheck.com.au, get a copy of this guide along with all of the other playbooks associated with this podcast series and all of our other best resources to help you move towards financial freedom faster. Make sure that you seek advice because this needs to be tailored to your specific circumstances in order to ensure that you get the most value out of it. But remember, a good idea in theory remains exactly that, and just a good idea until you put it into practice. So make sure that you take action. Reach out to me if you've got any questions. And make sure that you join us for the next episode on the podcast where we're going to be going into the automate investment component of our Create system, where we're going to show you how to put in place the investment operating system. Look forward to catching you on the next episode. We'll catch you then.